Howdy, y'all. Welcome to Liberty Call. It is Thursday, August 25th, 2022. Hope everybody's having a fantastical day out there in the interwebs. I'm just sitting here watching a deer munching on some of the grass in my yard. Kind of entertaining. So no bears in the last couple days, which is good. If you missed the bear footage, I think that was Tuesday. I had a picture up on the screen. I don't have it readily available, else I'd share it again. So if it's your first time watching Liberty Call, please give me a big old thumbs up, like, share, subscribe, all that great stuff. Smash that subscribe and like button. I would greatly appreciate it. Trying to channel my inner Tim Pool. He's he's way more exciting than I am. But anyways, looks like the market is, I guess, taking what's going to happen, or what the Fed meeting at Jackson Hole tomorrow. They're taking it in good stride, I guess, based upon at least how things are domestically. The traders are fairly happy, but we'll see. We're going to cover that in an article and a tax tip, and nothing today about the student loan forgiveness. I covered that yesterday, and I think most people who know me well know where I stand on that. I personally think it's a giant waste of money and does nothing but teach people bad habits about not repaying their obligations. And maybe that's the debt collector in me that spent the better part of the last half of the 90s and the first half of the 2000s as a collection and recovery agent and hunting down people who didn't want to pay their bills. So I have a different perspective than most. And maybe that's why I care so much about my own credit. Anyways. All right. Well, let's go ahead and jump into the markets and see how they did today. The Dow Jones was up almost 1% at up 0.98 at 33,291, was up 322 points. That took a massive jump in the last hour or so. It had been up about 100 points and fallen down into the red a little bit for, I guess, a short stretch. But again, I think a lot of people are showing some exuberance for what I honestly have no idea what they think is going to happen tomorrow. But anyways, the S&P 500 was up 1.46%, closed at 4201. NASDAQ up 1.67, closed at 12,639. Small caps are up over 1%. The VIX fell today, 4.56%. It's currently 2178. Other exchanges around the globe, Canada was up 0.75, Brazil up 0.52, Mexico up 0.57. Jumping over to Europe, Germany was up 0.39, UK up 0.11, France slightly down 0.08%. The Euro Stoxx was up 0.19. Netherlands, is that Netherlands? Yeah, Netherlands up 0.62, Spain down 0.15, Italy up 0.1, Switzerland up 0.46, and Portugal down 0.11. Moving further east, the Russian markets were split, but basically flat. The MOEX was down 0.08. The RTSI was up 0.03, so not much of a change there. And headed over to the Asian markets, Japan was up 0.58, Australia up 0.71, New Zealand down 0.14. In the Chinese markets, they appear to be all green. The Shanghai was up 0.97, the SESE component up slightly at 0.06, the China A50 up 1.29, the DJ Shanghai up 1.03, and the Hang Seng was up 3.63% today. Big jump. And the Taiwan weighted came in up 0.87. So, like I said, most of the day, across the globe, all the way around, most things were in the green. A few reds across here and there, but looking here, I don't see anything other than, was this little country? Sri Lanka was down 2%. But other than that, the ones that were down were, just down a smidge. All right. Well, let's read through today's market recap and see how things did across the financial world. S&P 500 rises on Nvidia-led climb and chips. Almost said chirps. Fed summit gets underway. The S&P 500 climbed Thursday, supported by a chip-led rally in tech and rising bank stocks as investors awaited fresh monetary policy clues as the Federal Reserve's Jackson Hole Symposium got underway. Semiconductor stocks rose more than 2%, supported by Nvidia Corporation, as Wall Street analysts shrugged off the chipmaker's weaker-than-expected quarterly results and guidance amid expectations that the soft patch in its gaming business is likely nearing a bottom. Morgan Stanley said it expected the chipmaker's gaming business to bottom in the October quarter, leading to a, quote, a fairly sharp rebound, end quote, in the division as soon as the January quarter. The positive sentiment from Wall Street analysts sparked a jump in other semis, including AMD, Micron Technology, and ON Semiconductor. Other tech, including cloud stocks, were mixed as Salesforce slumped while Snowflake surged. Salesforce reported quarterly results that topped analyst expectations, but softer guidance dragged the stock more than 5% lower. Quote, Salesforce CEO Benioff said the company is seeing some elongated sales cycles and more scrutiny of deals, which the company expects will continue in, 2H, resulting in softer outlook. In quote, Wedbush said as it cut its price target on the stock from $215 from $225. The way some people, I would say from $225 to $215, but they always say things weird. Maybe it's a computer writing this. Snowflake rallied more than 22% after the cloud data company's better than expected revenue, driven by growing production revenue, offset a wider than expected quarterly loss. Financials were boosted by rising bank stocks. Meanwhile, as economic data further cooled fears about an imminent recession. Citigroup, Huntington Bank shares, Principal Financial Group were up more than 1%. Second quarter GDP on an annualized basis was revised to a decline of 0.6 from 0.9, as consumption was also revised higher to 1.5 from 1% previously. The signs of a stronger consumer come just as the Fed kicked off its annual summit, with Fed Chairman Jerome Powell set to deliver fresh clues on monetary policy on Friday. Quote, my best case scenario is Powell will be a little more hawkish, but I worry he may not be hawkish enough to really tighten the financial condition, end quote. Ziwi Rin, managing director and portfolio manager at Penn Mutual Asset Management, told investing.com on Thursday. A less hawkish Fed would not only risk inflation staying higher for longer, but also dent short-term treasury yields, which have recently priced in the prospect of a more hawkish Fed policy. Quote, if Powell isn't hawkish enough to meet the market expectation, the front end of the Treasury yield curve will really come down as traders who are in short positions are forced to cover, end quote, Rin added. Yeah, it's kind of a strange thing. I guess if the Fed comes out and says, yeah, looking at the data, we're gonna start slowing things down, that the traders could take that as, well, the worst is behind us, and we wind up people wind up dumping a lot of excess capital back into the equity markets, only to have things, if they turn out to be worse than expected, losing your shirt by doing that. Or if he comes out and is extra hawkish, maybe people take that as a sign of, well, he's, things will be better, say, next year, so I'll hold things aside. So it's really a tough game right now as far as, where things will go. As far as, improving the GDP number from a 0.9 to a negative 0.6. Again, that could be taken two different ways. It could be like, well, the people at the Fed could say, well, GDP is actually better than expected, so that means the economy's still running too hot, so we have to continue to, increase rates at a more furious pace. So again, I guess anyone could look at the data and find what they want just looking at it right now. All right, next up. This comes from Zero Hedge. Quote, does it even matter if the Fed hikes 50 or 75 basis points? It won't prevent the multiple train wrecks coming our way, end quote. That's probably true. Let's see here. When reading the financial press these days, one could be forgiven for getting the impression that right now it's, quote, all about the Fed's next move and what Powell is going to say on Friday, end quote. I think we just kind of talked about that. Our colleague Philip Murray, I'm not sure how you say that, gave his views in yesterday's Global Daily, and with his message basically being that it is now time that market participants are to be told the truth. And the truth, unfortunately, is not a happy message. Inflation is already so much entrenched now that the Fed cannot afford to take its foot off the brakes, no matter what the economy or the labor market do in the foreseeable future. Yet in the grander scheme of things, one could ask, does it even matter whether the Fed adds 75 basis points or 50 basis points? It would neither speed up nor prevent the multiple train wrecks that seem to be coming our way. Although Joseph Stiglitz, in an interview in Germany, argued that too forceful rate hikes could even exacerbate inflation if higher interest rates slow down the necessary investments to alleviate supply shortages. Is he now in the Erdogan camp? But it is difficult to argue against his observation that rate hikes don't solve energy or food shortages, a point we have been making from the start of this crisis. So the awful truth is that it's real and potentially very bad, no matter how you twist or turn things. The current scorching European summer is likely to end up in the history books as one of the driest in centuries. Those who have visited the south of Europe in recent months can probably attest: extremely dry fields, trees shedding their leaves, and the closure of nuclear plants due to the lack of cooling water and water-saving measures all around. The impact on harvests could be significant, and the impact on electricity prices is already a fact. The French 1M forward baseload power contract briefly hit Euro 700 megawatts per hour on Monday, where some European 50 megawatts was the norm in the 5 years up to 2021. The average household in France uses about 5.5 megawatts per year. But now China has also joined the drought club, or rather the country is dealing with both drought and floods. Heavy rainfall in the north of the country have triggered severe flash floods, whereas high temperatures have caused significant water shortages in the south. The latter is not only affecting hydropower output in the region, 18% of its energy production in 2020, forcing greater use of coal, but also puts food production at risk, particularly along the Yangtze River and the Sichuan Basin, where around half of the nation's rice is produced. The situation is said to be perilous. Xinhua News reported that, quote, as of Monday, the drought has affected 3.4 million people and 48.48 million million hectares of farmland in 10 provincial level regions in the Yangtze River Basin, including Zhongxing, Sichuan, and Hubei. China's cabinet said it will set aside $10 billion to support rice production. However, should the droughts force China to increase food imports, this could put further pressure on the global food commodity prices. A sharp decline in the FAO's food price index in July, albeit after even sharper gains since January, was met with some relief last month. But this index has probably risen again in August, underscoring that the risk of global food shortages has not receded. Far from that, actually, and in the recent rise in natural gas prices is only aggravating the longer-term risk. Yesterday, CF Industries Holdings, a major fertilizer producer, said that its UK unit intends to temporarily halt ammonia production as it's uneconomical at current gas and carbon prices. This obviously spells more trouble ahead. According to the UN's FAO, nearly 30% of global production was experiencing modest to severe food insecurity, up from 25% in 2015, and it's hard to believe that this trend has reversed in the past 2 years. As we've noted before, the squeeze on households' income is real, and Western governments are looking to ways to soften the blow. Yesterday, U.S. President Biden has announced they plan to forgive up to $10,000 in student loans, which are a burden for many Americans. Well, I guess they don't care about the burden on the taxpayer. The amount of federal student debt outstanding is about $1.6 trillion, and then there are the loans that were issued by private parties. About 1 in 5 Americans has a student loan, although the amounts will be relatively small for most of them, less than $20,000. That said, these borrowers often find it the hardest to repay their debt, simply because these smaller amounts are held by former students that have moved on to lower paying jobs. So Biden's policy will certainly help many U.S. households. The Biden administration boasted that 90% of those earning under $75,000 per year. Technically, that may be true. However, it will mostly go towards the middle class, while the lowest income quintiles benefit much less, simply because this group is less likely to have attended tertiary education. Meanwhile, there are concerns about that this waiver could further boost inflation. After all, It gives the households a little more disposable income, and that burden would partly fall on shoulders of lower income households, many of which are already struggling to cope with higher prices. For example, electricity. Although the increase in U.S. energy bills pales in comparison to the price hikes faced by Europeans, there are now 20 million households in arrears on their utility bills, which could see the power being shut off temporarily for many Americans. Yet, the U.S. government does not seem to be in a hurry to offer any assistance on that front, unlike the quick measures that are taken as soon as prices at the gas station rise significantly. So again, everyone's hand-wringing about what's the Fed going to do, what's going to happen to Jackson Hole. What I would remind everyone is the Fed created this problem by all the money printing 2 summers ago. So it's kind of like if your local fire department were to set your house on fire, and then when you say, hey, could you please put it out? They get a garden hose and they're just kind of spraying it, and your house is in a giant inferno. I mean, yeah, it's water, but is it really going to put the fire out in a short order? Probably not. You really need a fire hose and maybe a few tanker trucks to get enough pressure to drench the flames. So again, I view the Fed as the arsonist who's also the fire captain, and he's standing there off to the side going, well, it's crazy. I don't know what happened. It's just a mystery. All right. One last article, some tax tips that from an article I found on Yahoo Finance. Here's how the rich avoid paying here's how the rich avoid paying savings account taxes, written by Mark Hinrichs. If you keep your money in regular savings accounts, you will generally owe federal income taxes on the interest that is earned. You'll pay taxes at your regular rate of that year interest is earned, whether or not you withdraw from the account. You can avoid paying taxes on interest with the help of certain tax-advantaged accounts used to fund retirement, healthcare, and educational expenses. However, these accounts come with restrictions that make them unsuited to keep emergency savings. To help you decide how to save for various purposes while minimizing your tax burden, talk to a financial advisor. I know someone, so you can reach out to me. Let's see here. Savings account interest tax basics. The conventional savings account accounts offered by most banks and credit unions and some other financial institutions, including online banks, are ideal for saving money for short-term needs. They often have some restrictions on the number of withdrawals monthly, so they aren't well suited for paying regular bills as checking accounts. But their owners can readily assess funds when needed, and they incur low and sometimes no monthly service fees. One drawback is that even high-yield savings accounts pay only modest interest that is rarely enough to keep up with inflation. And to make matters worse, the Internal Revenue Service expects its owners to pay income taxes on the interest that it earned. Taxes are levied at the owner's regular tax rate according to income and must be paid even if the interest is left in the account as opposed to withdrawn or spent. Yeah, the federal government can't live without robbing us blind. In most cases, the tax that you're required to pay from the interest earned in your retirement account cannot be avoided. Most places where you park your cash, especially safe places to keep your money like a savings account, require you to pay tax on earned interest. Once you hit the threshold of $10, it will be reported to the IRS, and there's no way around paying that tax. However, there are 2 ways to avoid paying taxes on interest earned in your savings account. Both ways involve saving your money in a tax-advantaged account and not in a regular savings account. These types of tax-advantaged savings accounts you need to look for are an account that lets you deposit pre-tax money, and number 2, an account that allows the money in the account to grow tax-free. Now, let's take a closer look at each type of savings accounts that you might choose if you're looking to avoid taxes on interest. None of these accounts offer the same flexibility as a conventional savings account, but they can save you quite a bit in taxes if you have a substantial amount saved. The major tax-advantaged savings account options are a Roth individual retirement account or a Roth 401k. Interest earned in a Roth account is not taxed until it's withdrawn. And if you're older than 59 and a half, you will owe no income tax on all of the interest. However, early withdrawals before age 59 and a half incur a 10% penalty in addition to any income tax due. Contributions to Roth accounts have already been taxed, so they can be withdrawn anytime without tax or penalty. And if I could stop there, that's actually Roth IRAs are, what I've found is a very good tool for, younger savers who maybe have small kids. You max fund out your Roth IRA. think when I started, it was 3,000 a year. Today, I think it's 6. I don't memorize these numbers anymore. I always go to the chart. But, so husband and wife could each put $6,000 into a Roth IRA every year for the, say, 20 years their kids are growing up. And so that $12,000 times 20 years, do the math, that's over 200 grand saved up. If Johnny or Susie doesn't go to college, it's there for your retirement. But you could always take out all that principal that you put in there over that span. And you only have to wait, it's either 5 or 6 years from the date you open the IRA, the Roth IRA, to when you can start taking funds out of the account, take the growth out of the account without having to pay taxes. So if someone opens up a Roth IRA at say 58, they have to wait till 5 or 6 years later to actually start making the withdrawals to get the tax benefit. Next up, traditional IRAs and non-Roth 401k accounts. These accounts do not pay taxes in the year interest is earned, as regular savings accounts do. However, when the interest is withdrawn, it is taxed at ordinary income. Withdrawals on interest or the previously untaxed deposits before age 59.5 also incur a 10% penalty, as well as being taxed as regular income. Coverdell savings accounts. These are designed to help parents pay for minor children's educational expenses. Interest earned on these funds in a Coverdell account can be withdrawn interest-free, but only if the money is used to pay for eligible education expenses. A 529 college savings plan. A 529 plan lets interest on deposits grow without taxes and also allows withdrawals free of tax when the money is spent on eligible education expenses. An HSA or a health savings account. An HSA allows its owners to deduct their contributions from current income and also avoid paying taxes on earnings and withdrawals. However, money has to be spent on qualified medical expenses. An FSA or flexible spending account. Another popular account, an FSA lets owners deduct contributions from current income and also avoid paying taxes on interest if the money goes for qualified medical expenses. FSA funds typically have to be used in the year they were contributed. It can be difficult to choose which of these options might be a good fit for your needs, but you don't have to make that decision on your own. You can work with a financial advisor to determine the best blah, 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 blah. And finishing up here, income taxes are generally due on any interest earned by a savings account, but there are ways to avoid paying these taxes. Special tax treatment of certain accounts designed to encourage savings for retirement, education, and healthcare. Healthcare exempts interest from taxes both when it is earned and often when it is withdrawn. However, these accounts also come with significant limitations, as we have already discussed, including restrictions on timing and the use of withdrawn funds. For that reason, conventional savings accounts are still useful for emergency savings and short-term savings purposes. All right, so there are ways to screw Uncle Sam out of a few bucks here or there, but just be careful. You don't put yourself in a worse tax situation by, putting money into an account and then you take it out early and then you have a big tax burden because, you weren't aware of the penalties. So, all right. Well, that's everything I had for today. I hope everyone found today's topics entertaining and stimulating. Woo! I'll be back tomorrow with the weekly wrap-up to go through all the economic data that came out this week and probably some news from the Jackson Hole meeting. I'm sure everyone's just going to be so excited about it. And we'll see what happens. So wishing everyone a fantastic evening, and I'll talk to you tomorrow. Adios.